How can a war on the other side of the world actually affect your investments? Let's get into it.
So let's start with the big question. How can a conflict that's happening thousands of miles away
actually impact your money right here in India? Well, the connection is surprisingly direct.
The answer? It's all about a global ripple effect. Think of it like a chain reaction.
And that first really big ripple, it almost always starts with crude oil.
See, this narrow waterway, the Strait of Hormuz, is a major choke point for the world's energy supply.
Just how important is it? Get this, 20% of the world's oil flows right through it.
And that's a huge deal for India, because we import nearly 90% of our crude oil.
This all sets off a four-step chain reaction that hits the Indian economy pretty hard.
When oil prices go up, so does India's import bill. A $10 jump costs billions more.
Then a weaker rupee makes those imports even pricier, which means, you guessed it, higher inflation for us.
But, not every sector feels the pain equally. There can be winners and losers.
For instance, oil exploration companies might benefit, while sectors like aviation definitely feel the squeeze.
With all this volatility, what's an investor supposed to do? What's the playbook here?
It really comes down to two mindsets, reacting out of fear versus sticking to a long-term strategy.
Smart investors usually stick to a few key rules, like diversifying and just not panic selling.
During a crisis, you'll often see investors run for cover, looking for so-called safe haven assets.
Things like gold and government bonds are common choices. Gold especially tends to do well. But here's the thing. History shows that while markets get rattled, they almost always recover over time. Which leaves us with a final thought. When everyone else is panicking, is that a threat or an opportunity?